Hi Team Value, JJ here, welcome back. Well, the Berkshire Hathaway annual general meeting was over the weekend and Warren Buffett spoke at length as he usually does, but without Charlie Munger this time. But he spoke on a number of subjects, including selling some Apple shares and what he sees the environment being like for deploying that huge amount of cash, which is approaching $200 billion. Let's see what Warren Buffett has to say this year.
It's quite an improvement from last year, but we would expect our earnings should go up modestly from year to year because, after all, we're retaining like $37 billion last year of earnings. So if we put $37 billion more, you left it with us, we should do something that's satisfactory. And the goal of Berkshire, economic goal, is to increase the operating earnings and decrease the shares outstanding. It's that simple to describe. It's not quite so simple to pull off necessarily.
Well, that's great. What he just said there, really important. The economic goal of Berkshire is to increase operating earnings and decrease the share count over time, which means buying back shares below intrinsic value. He didn't add that there, but he has elsewhere. So they only buy back shares when he knows and Charlie Munger knew that the shares were trading below intrinsic value, and so that should increase the share price over time. But that's the economic goal that he said. Those two things, increasing incrementally operating earnings, he said, modestly year by year there, and decreasing share count, which they have over recent years.
Just given what you mentioned, there was some news that came out in the 10Q this morning. It shows that Berkshire sold another 115 million shares of Apple in this last quarter. That's Berkshire's largest holding. And I think in that vein, we'll start with a question from Sherman Lamb. And he asks, last year you mentioned Coca-Cola and American Express being Berkshire's two long-duration partial ownership positions. And you spent some time talking about the virtues of both these wonderful businesses in your recent shareholder letter. I noticed that you have excluded Apple from this group of businesses. Have you or your investment managers' views of the economics of Apple's business or its attractiveness as an investment changed since Berkshire first invested in 2016?
No, but we have sold shares, and I would say that at the end of the year, I would think it extremely likely that Apple is the largest common stock holding we have.
So they've sold shares in Apple. It's the largest shareholding, and let's just have a look at that. So this is Berkshire Hathaway's stock portfolio here, and as we can see, it's 46.87% of the portfolio Apple, and this is before this previous quarter, so this will update soon. But I would say that this is probably why they sold. It's a huge percentage of the portfolio, so the amount they sold, it's still going to be the biggest, and he said by the end of the year it's likely to be the biggest. Still, he doesn't mind having an outsized percentage of a company in the portfolio, obviously, otherwise he wouldn't have let it run up this much, but it's still a huge percentage, so we keep that in mind as he's talking here.
One interesting thing is that Charlie and I looked at common stocks or marketable equities, or the things that people love to look at, as being businesses. And so when we own a Dairy Queen or we own whatever it may be, we look at that as a business. And when we own Coca-Cola or American Express or Apple, we look at that as a business.
So making the point there that stocks are slices, tiny slices of businesses. Of course, they own big slices of businesses, but even retail investors, when we own a few stocks in a big company, we still own part of that business. And he's always made that point as well.
Now, we can buy really wonderful companies in the market as businesses. We can't buy all of them. All of their shares. We can't buy 90% or 80% or anything like that. But when we look at Coca-Cola and American Express and Apple, we look at them as businesses. Now, there's differences in tax factors. There's difference in managerial responsibility, a whole bunch of things. But in terms of deploying your money, we always look at every stock as a business. We have no attempt made to predict markets. We have no attempt made to pick stocks. I went through many, many years doing the wrong thing. I got interested in stocks very early, and I was fascinated by them. And I wasn't wasting my time because I was reading every book possible and everything else. But finally, I picked up a copy of The Intelligent Investor in Lincoln, and there was a few sentences in there that that said much more eloquently than I can say it. But if you look at stocks as a business and treat the market as something that doesn't tell you, isn't there to instruct you, but it's there to serve you, you'll do a lot better over time than if you try to take charts and listen to people talk about moving averages and look at the Fed pronouncements and all of that sort of thing.
So he's talking about not trying to predict the market, which I've talked about many times. A lot of people on finance media do that every day. They have people on there who predict the market. So he's talking about looking at the fundamentals of the business rather than looking at the stock, thinking of stocks, thinking of the business instead. He's often said that he wouldn't care if the share market closed for 5 to 10 years because it's really about the business. As long as the business keeps going in the right direction, the stocks should work out fine. Now, if you're getting value out of this Warren Buffett episode so far, I'd really appreciate it if you manage to remember to hit that like button to help the episode to spread to more people. Thanks.
So that made a lot of sense to me then. And the way I've been allowed to deploy it, and Charlie and I talked about this, of course, constantly. It's changed over the years as the amount of capital we have has changed and all of that. But the basic principle was laid out by Ben Graham in that book, and which basically said to me, you've been wasting your time now, but maybe you can use what you've learned or been reading about and put it to better use. And then Charlie came along and told me how to put it to even better use.
So what he's talking about there with Charlie Munger telling him to put it to better use before Charlie came along, he didn't mind buying not very good businesses as long as they were trading for way below intrinsic value, and then buying them and waiting till they got to their fair value or above. And Charlie said it's better to buy excellent businesses, wonderful businesses for a fair price than fair businesses at a wonderful price. That's a big change, and that's really what started off the massive compounding. He obviously did do very well before that, working in that different way, investing in that different way, but that was a big change that a lot of people have taken on and they learned from Charlie Munger.
The story of why we own American Express, which is a wonderful business. We own Coca-Cola, which is a wonderful business. And we own Apple, which is an even better business. And we will own, unless something really extraordinary happens, we will own Apple and American Express and Coca-Cola when Greg takes over this place. And
when Greg takes over, talking about Greg Abel there, who's going to take over as a CEO. So he's talking about when he's not there anymore, which is, as he said during this AGM, 5 years or more, he hopes.
It's such a simple approach that it's almost deceptive. Most things, if you keep working harder and harder at it, you learn a little more math or you learn a little more physics. But investments, you don't really have to do that. You really have to have your mind set properly. So we will end up, unless something dramatically happens that really changes capital allocation, a strategy, and we will have Apple as our largest investment. But I don't mind at all, under current conditions, building the cash position.
Well, that's an interesting statement too. Under current conditions, he doesn't mind building the cash position, and it's a massive cash position. It's not going to be long before it reaches 200 billion if they don't deploy that cash. And he's said in this AGM, in this meeting, that he doesn't mind waiting. I think he thinks things are generally pretty expensive. They said they can't really find anything to buy. And of course, they have to buy massive things to move the needle. So they have to wait until really the big companies, the pool of companies that they've got to invest from, get to a good value. And he obviously thinks they're expensive now, whatever he's looking at, apart from some that they've bought in energy and in Japan. And he also said in this meeting that they are currently looking at something in Canada.
I think when I look at the alternative of what's available in the equity markets, and I look at the composition of what's going on in the world, we find it quite attractive.
Finding cash attractive, he's talking about there, because the interest rates aren't bad, so he doesn't mind sitting in cash, and a huge amount of cash or treasuries. Excuse me, just pausing to have a sip of coffee made with my AeroPress coffee maker, which I highly recommend. I do own shares in the company with a controlling interest in AeroPress, which is Tiny Limited. I've made videos about Tiny before, but I wouldn't recommend anything that I don't truly love the product, and this makes fantastic coffee. I'm going to leave a link in the description to the Amazon store if you want to check that out. Don't take my word for it. There are so many great recommendations of the product. Just read through them, and it's not expensive for what it is.
All right, Warren, earlier you talked about selling some of the Apple shares in order to build up your cash supply, and I think it's had a lot of people wondering where you see opportunities or what might be coming or market valuation. So I'll ask this question from Foster Taylor. At the 1999 annual meeting, you mentioned that if you owned all of America's 500 businesses, you would be making $334 billion while paying $10.5 trillion. You emphasized that this was not a good return on investment. Today, by my math, the S&P 500 has a market capitalization of around $44 trillion with profits of around $1.45 trillion. This is a very similar return on investment to the 1999 levels. Do you see similarities in the market today and the 1999 levels?
In 1999, of course, the top of the dot-com bubble there.
There have been times in my life that I've been awash in so many opportunities that I could have invested everything by nightfall. And then there's other times when the year goes, well, not in the early days, but now we haven't seen anything that makes sense that moves the needle.
Moving the needle, meaning that they have so much money, nearly $200 billion. So they really have to buy massive businesses or slices of massive businesses to move the needle. If he just had a few $1 million, it would be a lot easier from that point of view. And that's maybe how retail investors have got an advantage to even Warren Buffett.
Now, we've made small acquisitions during the year. Our companies have made acquisitions, and Greg and I may talk about something that involves a $300 million purchase or something like that. And if it fits well enough, we do it. And if our managers see things that fit them, we want to look at them because our managers do not have necessarily the same equations in mind that we do. This is not a time when the phone is going to be ringing often, but there are times from that. And Greg will know how to handle them as well or better than I have over time. And Charlie and I, we missed a lot of things. What we really regretted was missing something that turned out to be very big. We never worried about missing something that we didn't understand. I mean, why should we be able to predict the future of every business any more than we can predict, what wheat yields are likely to be in Illinois next year? I don't really think of whether it's similar to 1999 because I'm not that good on chronology anyway, unless something really dramatic happened at the time. I mean, I remember things from 2008 and 9 much better than I remember whether something happened in 2015 or 1987 1987 I remember because of October 19th, but I don't think that way. I just look at what I can do every day.
So when he indicates that the phone's not ringing much these days, it means that there's not a lot of distress out there. In the great financial crisis, the phone did ring and companies get into distress. They go to Berkshire because Berkshire has so much cash that they can lend money and get companies out of problems, out of trouble in exchange for shares. And so that's what he's referencing there. So he waits for those opportunities, and one of those opportunities might come along, but now is not a good time. They can't find many opportunities. After the dot-com bubble burst, Berkshire did very well at not getting involved in that hype and the tech hype and the bubble there, just biding their time. And they had a really good stretch after that, after people were pressuring them to buy tech things during that bubble as it rose and rose. And of course, they didn't do that. And they came out well on the other end, and that could happen again if there's some sort of crisis.
This question's from Johan Halen, who writes, you're sitting on $168 billion of cash, which you told us today is now more than $182 billion. His questions are, one, what is Buffett waiting for? And two, why not at least deploy some of it?
Well, I think that's pretty easy to answer. I don't think anybody sitting at this table has any idea of how to use it effectively, and therefore we don't we don't use it, and we don't use it now at 5.4%, but we wouldn't use it if it was at 1%. Don't tell the Federal Reserve that, but I prefer it.
He's talking about there the interest rates being decent, so having that much cash, obviously they're getting a lot of interest on that while it's sitting there. But he said that they don't know how to deploy it, meaning that they don't see any good opportunities, not that they don't know how to, just in the current environment.
We only swing at pitches we like, and if anybody tried to swing at every pitch or felt that because they hadn't swung at a pitch for the last 2 pitches, they ought to swing at the third one or something like that. There are times, and they're obviously, but I would say this, I would not like to be running 10 billion now. 10 million, I think Charlie or I could earn high returns on, because I think there are just a few things that happen on a very, very small scale.
There you go. He said that if they had less money, they could do much better. He has said before that he just said if he had a few million, he could pretty much guarantee getting 50% a year. But with the vast amount of money that they've got, they have to find huge scale opportunities, and they're not seeing those at the moment in the current conditions. When they're distressed, when there's market distress, economic distress, that's likely the time that they'd be able to find things.
If we had 10 billion, I wouldn't basically see many more opportunities than we found. Now, it's true that something like Japan we could have done if the company had a 30 or 40 billion, and we'd have had great returns on equity. But if I saw one of those now, I'd do it for Berkshire. It's just that things aren't attractive, and there's certain ways that can change, and we'll see whether they do.
There you go. He's saying if things change, if economic conditions change, if there's some distress around, they're just not seeing those opportunities. He said that a number of times, repeated that a number of times during this session, that they're not seeing those opportunities, but we'll see what happens. It's like he's expecting something to happen sooner or later. Not soon, but sooner or later. Now, I'd love to know what you think about Berkshire Hathaway selling some Apple shares, a good chunk of Apple shares. Do you think they're doing the right thing, given that it's a huge part of their portfolio? Or do you think that they'll regret doing that? What do you think? Let me know in the comments. And do you think they should be deploying some of that huge amount of cash that they've got, nearly $200 billion? Now, I've got some exciting news about the Art of Value Patreon. If you're not aware, I've just created the Value Supporter tier, which is just $1.50 per month. And with that, you do get some bonus content regularly, less than the Value Angel tier, which is $5 a month. And being a kind supporter of the Art of Value is really what this tier is for, but you do get some exclusive content as well. And for the Value Angel tier, if you want to join that, you get exclusive videos. I go more in depth, things that I don't say anywhere else. My portfolio's on there, so I'll leave a link in the description if you want to check that out. Now, I'm going to put some related episode links in the description if you want to see more. And if you're watching this on YouTube, I'm going to put a link here to what YouTube thinks that you in particular should watch next. So go and see any of those now if you want to. And thanks to everybody for watching or listening, wherever you're doing that. And I'll see you in the next one.